The year 2017 was marked by specific economic promises. These promises primarily focused on increasing employment opportunities. Another key promise was the prospect of higher wages for workers. The economic narrative also included the promise of a more affordable cost of living. By 2019, the economic landscape showed positive trends in wage dynamics. Real wages experienced a growth rate that outpaced the prevailing rate of inflation. This meant that the actual purchasing power of wages was increasing. Many workers benefited from this increase in their capacity to purchase goods and services. The rise in real wages reflected an improvement in the financial well-being of a significant portion of the workforce. The year 2020 marked a period of substantial economic upheaval. This disruption broke established economic patterns and norms. The COVID-19 pandemic introduced unprecedented challenges to the global economy. These challenges necessitated adaptation and innovation across various sectors. By 2025, a significant concern arises among Americans regarding the cost of living. This concern questions whether the expenses required for basic survival are justified. The core issue is a perceived imbalance between the cost of living and the perceived value of life. This imbalance suggests that essential expenses may be disproportionately high. The question is raised across different generations of Americans. This widespread concern highlights a potential crisis in affordability and quality of life. The cost of basic groceries has seen a noticeable increase between 2017 and 2025. This comparison highlights the changing economic landscape affecting consumer goods. Staple food items now require a larger portion of household budgets. Rising grocery prices reflect broader inflationary trends in the economy. Consumers are adapting to these changes by seeking cost-effective alternatives. Housing price charts visually represent changes in the cost of residential properties over time. These charts typically illustrate an upward trend, indicating increasing housing prices. The rise in housing prices contributes to the growing unaffordability of homes for many individuals and families. Unaffordability is exacerbated by factors such as limited housing supply and rising interest rates. Affordability challenges significantly impact workers across various sectors. Families face difficulties in maintaining their living standards due to rising costs. Small businesses struggle with operational costs, affecting their sustainability. These challenges collectively affect economic stability and growth. Addressing affordability is crucial for supporting workers, families, and small businesses. The phrase "affordability is the new American battleground" highlights a key area of contention. This statement suggests that access to affordable goods and services is a major point of conflict. Affordability has become a central issue in American society. This concept frames affordability as a fundamental challenge. Frame affordability not merely as a political debate. Instead, consider affordability as a fundamental moral question. This perspective emphasizes the inherent dignity of every individual. It also highlights the importance of stability in people's lives. Affordability is intrinsically linked to fulfilling the American promise of opportunity for all. The panel includes hosts from different generations. The generations represented are Gen Z, Millennials, Gen X, and Boomers. Each generation brings unique perspectives. These diverse viewpoints enrich the discussion. The panel aims to explore topics through various generational lenses. Gen Z faces unique economic challenges compared to previous generations. A key issue is the lack of perceived affordability gains in essential sectors. High rental costs significantly diminish Gen Z's financial flexibility. These housing expenses consume a large portion of their income. This limits their ability to save, invest, or spend on other needs. Consequently, Gen Z feels a disproportionate economic burden. Millennials have experienced wage increases over time. However, the cost of essential needs has risen disproportionately. Housing costs have increased at a rate faster than wage growth. Childcare expenses also outpace the increase in wages. This imbalance offsets the benefits of wage growth for millennials. Generation X experienced periods of real wage growth. This growth contributed to a sense of economic security for many in the generation. The COVID-19 pandemic significantly disrupted this economic stability. The pandemic led to job losses and economic downturn. These events undermined the previously experienced wage gains. This highlights the vulnerability of economic security to unforeseen events. Boomers express a sense of betrayal due to the current affordability crisis. This sentiment contrasts with their perception of stability during the Trump years. The affordability crisis is a key factor driving this disappointment. Boomers' views reflect a shift in economic conditions and personal financial security. The perceived stability of the past is juxtaposed with present economic challenges. This perspective highlights the impact of economic policies on different generations. The first thematic round focuses on the period from 2017 to 2020. This round analyzes the relationship between wages and prices during this time frame. It examines how changes in wages affected prices. It also investigates how changes in prices influenced wages. The analysis aims to provide insights into the economic dynamics of the period. This round serves as an introduction to the broader topic of wages versus prices. Real wages experienced a period of growth exceeding the rate of inflation. This indicates an increase in purchasing power for workers. Unemployment rates reached historically low levels. These factors suggest a period of significant economic prosperity. Economic gains were not evenly distributed across the population. Housing costs increased faster than wages in major cities. Healthcare expenses also outpaced wage growth. This disparity creates financial strain for individuals in metropolitan areas. The COVID shock, 2020, represents the second round of analysis. This round focuses specifically on the economic disruption caused by the COVID-19 pandemic. It examines the initial impacts and immediate aftermath of the pandemic on global economies. The analysis likely includes key indicators and economic trends observed during this period. It aims to provide a comprehensive understanding of the economic challenges and changes that arose. This round serves as a critical assessment of the pandemic's immediate economic consequences. Emergency relief measures were implemented to mitigate the economic impact of the COVID-19 shock. These measures aim to provide immediate financial assistance to households. The interventions temporarily increased household income during the crisis period. This income boost helped to stabilize consumer spending and prevent a deeper recession. The relief efforts provided a short-term buffer against the negative economic consequences. However, the long-term effects of these measures require further evaluation. The COVID-19 pandemic triggered significant job losses across various sectors. Economic instability increased due to business closures and reduced consumer spending. Long-term economic challenges, or scarring, emerged as a result of prolonged disruptions. These combined factors led to a decrease in affordability for many individuals and families. Millions experienced a decline in their ability to afford essential goods and services. The COVID shock thus had a widespread and detrimental impact on economic well-being. The period from 2021 to 2025 is characterized by a significant surge in inflation. This inflationary period represents a distinct economic phase. The 2021 to 2025 inflation wave specifically examines this era of rising prices. This analysis focuses on understanding the factors contributing to the inflation. The study aims to provide insights into the dynamics of inflation during these years. The inflationary trends of 2021 to 2025 are the central subject of this investigation. Some argue inflation was a global phenomenon. This perspective suggests inflation was not directly caused by specific policies. Specifically, some analysts contend it wasn't solely attributable to Trump-era policies. Instead, broader global economic factors may have been the primary drivers. Some analysts attribute the inflationary crisis to underlying structural issues. These vulnerabilities are believed to have been present from 2017 to 2020. The structural weaknesses amplified the impact of inflationary pressures. This perspective suggests that pre-existing conditions worsen the crisis. Addressing these vulnerabilities is crucial for preventing future inflationary events. The 2025 affordability crisis is the focal point of Round 4. This round specifically addresses current economic challenges. The core issue revolves around the increasing difficulty in affording essential goods and services. This crisis encompasses various factors impacting financial stability. Round 4 aims to explore and analyze the underlying causes and potential solutions to this affordability crisis. Grocery prices have increased in 2025. This increase contributes to a broader affordability crisis. The rising cost of groceries impacts household budgets. Consumers face challenges in affording essential food items. Rent prices have seen a notable increase. This increase puts additional pressure on household budgets. Many families are now finding it more difficult to afford housing. The rise in rent contributes to overall financial strain. This situation may lead to housing instability for some. Insurance costs are increasing in 2025. This increase adds to the overall financial strain on individuals and businesses. Rising insurance premiums can impact household budgets. Businesses may face challenges in managing operational expenses due to higher insurance rates. The increased financial burden necessitates careful planning and budgeting. Energy costs are subject to fluctuations. This volatility introduces unpredictability into household budgeting. Consumers face uncertainty regarding future energy expenses. Effective financial planning requires adapting to these variable costs. Real wages reflect the actual purchasing power of income after accounting for inflation. They indicate the quantity of goods and services that can be bought with earnings. Currently, real wages are facing difficulties in maintaining their value. This struggle is primarily due to the increasing costs of goods and services. As prices rise, the same amount of money buys less, reducing real wages. This situation impacts the living standards and financial well-being of individuals. The central debate revolves around the origins of the 2025 crisis. One perspective posits that the crisis's foundations were laid well before 2020. This view suggests long-term systemic issues culminated in the events of 2025. The opposing argument claims the crisis stemmed from dynamics unique to the post-2020 era. This perspective emphasizes recent events and policy changes as primary drivers. This section delves into the moral questions arising from the economic landscape. It examines the ethical considerations inherent in various economic activities. The focus is on understanding the moral dimensions of economic decisions. It explores the ethical impact of economic policies on different groups. The discussion includes the moral responsibilities of economic actors. Ultimately, it seeks to foster a more ethically informed economic perspective. The question challenges the conventional definition of economic success. It implies that a thriving economy should translate to a reasonable standard of living for its citizens. Affordability of a stable life becomes a key indicator of economic health. It questions whether aggregate economic indicators accurately reflect individual experiences. Economic success should ensure basic needs and security for the average person. The discussion transitions from empirical data to abstract reasoning. Statistical analysis gives way to philosophical inquiry. The focus shifts towards underlying principles and values. Debaters explore ethical implications and theoretical frameworks. Arguments become centered on abstract concepts rather than concrete evidence. The host transitions to a synthesis phase. This involves stepping back from the individual arguments. The objective is to reframe the entire debate. Reframing provides a broader perspective. It aims to identify common ground or overarching themes. This sets the stage for a consolidated understanding. Affordability is distinct from gross domestic product, GDP, as an economic indicator. GDP measures a nation's overall economic output. Affordability reflects the real-world financial capacity of families. It focuses on whether families can meet their basic needs and maintain a reasonable standard of living. Financial life stages reflect key transitions in a person's economic capabilities and concern. These stages are defined by the ability of young people to achieve independence. They also encompass a parent's capacity to save and secure their family's future. Furthermore, they address a retiree's ability to live comfortably without financial anxiety. Overall, financial life stages represent the economic milestones and challenges individuals face throughout their lives. The Trump administration's economic policies led to varying impacts on different segments of the American population. Certain groups experienced an increase in their purchasing power during this period. However, these economic benefits were not universally distributed across all demographics. Some Americans were left behind, failing to experience the same level of economic improvement. This resulted in a widening gap between those who benefited and those who did not under the Trump economy. The affordability crisis of 2025 highlights a fundamental issue in America. America's challenges extend beyond mere economic growth. There is a pressing requirement for greater fairness in the distribution of resources and opportunities. Addressing this need for fairness is crucial for long-term societal well-being. Boomers experience financial advantages due to asset appreciation. Asset appreciation refers to the increase in the value of assets over time. These assets can include real estate, stocks, and other investments. Boomers benefited from favorable economic conditions that drove asset values higher. This appreciation contributed to their overall wealth accumulation. The timing of their entry into the market played a significant role in this benefit. Generation X faced unique economic pressures. These pressures included the rising costs of childcare. Healthcare expenses also significantly impacted Gen X. Many Gen X individuals were also responsible for the care of aging parents. This combination of factors created a financial squeeze for this generation. Balancing these responsibilities presented considerable economic challenges. Millennials faced significant challenges due to rising housing costs. Increased property values made homeownership difficult for this generation. Many millennials were priced out of the housing market. This financial pressure affected their ability to save and invest. Gen Z faces significant financial hurdles entering the workforce. Rising costs of living outpace entry-level wages for this generation. Housing affordability is a major obstacle for Gen Z. Student loan debt further exacerbates their financial strain. Limited opportunities for wage growth early in their careers impact their financial stability. These economic factors create a challenging landscape for Gen Z's financial future. Structural costs represent fundamental expenses impacting affordability. These costs primarily include housing expenses. Healthcare costs also constitute a significant structural burden. Education expenses are another key component of structural costs. Childcare expenses further exacerbate structural affordability barriers. The 2025 crisis acted as a significant warning. It exposed vulnerabilities in maintaining affordable living standards. Prior progress in affordability was revealed to be unstable. The crisis highlighted the need for more resilient economic strategies. It prompted a reevaluation of factors impacting financial security. Economic shocks can significantly impact household financial stability. Households are often vulnerable to unforeseen economic downturns. A crisis reveals the degree to which households are susceptible to these shocks. Understanding this exposure is crucial for implementing effective economic safeguards. The strength of an economy is directly linked to the financial well-being of its population. A robust economy ensures a significant portion of its people can afford a decent standard of living. Economic indicators should reflect the affordability and accessibility of essential goods and services. A thriving economy empowers individuals to participate actively and contribute to its growth. Therefore, economic health is measured not just by production, but by the living standards it supports. The statement poses a question about the affordability of life during the Trump economy. It suggests a potential reevaluation of the primary focus. The question implies that affordability might not be the most critical aspect to consider. It opens the door for exploring alternative metrics or perspectives on economic well-being. This prompts a deeper analysis beyond simple cost of living assessments. The central question is defining the economic legacy for future generations. This involves considering the type of economy that should be passed on. It prompts reflection on long-term economic sustainability. Ethical considerations play a key role in shaping this future economy. The goal is to ensure a responsible and equitable economic system for those who inherit it. The period from 2017 to 2025 is marked by a significant issue: affordability. Affordability acts as a fault line, indicating a critical point of tension or division. This suggests that access to essential goods and services became increasingly challenging. Economic disparities and cost increases likely contributed to this affordability crisis. The term fault line implies that this issue could have widespread social and economic consequences. Real wages are nominal wages adjusted for inflation. They reflect the actual purchasing power of earnings. Economic shocks can significantly impact real wages. Inflation erodes real wages if nominal wages do not keep pace. Economic stability is a state where an economy experiences consistent growth and minimal fluctuations. It is characterized by low inflation, stable employment, and predictable financial markets. Different generations often experience and perceive economic stability differently. Older generations may recall periods of greater stability or significant economic shifts. Younger generations face new economic challenges, such as globalization and technological disruption. These differing experiences shape their views on economic security and future prospects. The cost of living refers to the expenses required to maintain a certain standard of living. These expenses include housing, food, transportation, healthcare, and other essential needs. A rise in the cost of living means that these goods and services are becoming more expensive. This increase can be driven by factors like inflation, supply chain disruptions, and increased demand. When the cost of living rises faster than income, individuals and families may struggle to afford basic necessities. This can lead to financial strain, reduced living standards, and increased economic inequality. Many Americans face significant challenges related to affordability. These challenges span various essential aspects of life. Housing costs are a major factor affecting affordability. Healthcare expenses also contribute to financial strain. Education and childcare costs further exacerbate these affordability issues. Different generations often hold varying perspectives on economic gains and opportunities. These perspectives are shaped by the economic conditions prevalent during their formative years. Older generations may value stability and traditional career paths based on their experiences. Younger generations often prioritize flexibility, innovation, and diverse income streams. Understanding these generational differences is crucial for effective economic policy and social cohesion. Gains or advantages are not always distributed equally among a population or group. Certain individuals or segments may experience more significant benefits than others. This disparity can arise from various factors, including socioeconomic status or access to resources. Uneven distribution can lead to increased inequality and social stratification. Understanding the causes of uneven gains is crucial for addressing disparities. Policies and interventions can be designed to promote a more equitable distribution of benefits. The COVID-19 pandemic significantly disrupted global economic progress. Lockdowns and restrictions led to decreased production and supply chain issues. Consumer spending patterns shifted dramatically, impacting various sectors. These factors combine to slow down or reverse economic growth in many regions. Inflation erodes the purchasing power of money over time. This erosion means each unit of currency buys fewer goods and services. As prices rise, the same amount of money has less real value. Consumers can afford less with their existing income during inflation. This particularly affects those on fixed incomes, like retirees. Reduced purchasing power impacts overall economic activity and consumer confidence. Affordability barriers represent ongoing challenges in accessing essential goods and services. These barriers disproportionately affect low-income populations. Limited financial resources restrict access to basic needs. Unaffordable housing creates instability and financial strain. High healthcare costs can lead to unmet medical needs. Lack of affordable education limits opportunities for advancement. Economic shocks can significantly expose vulnerabilities within households. These shocks often lead to reduced income and increased financial strain. Households with limited savings or high debt are particularly susceptible. Understanding these vulnerabilities is crucial for effective policy interventions. Fairness is a crucial element for a robust economy. It ensures equitable opportunities for all participants. Fairness promotes trust and cooperation within the economic system. It fosters stability and sustainable growth. A fair economy encourages innovation and productivity. The future economy state is determined by current economic policies and practices. Technological advancements will significantly shape future economic landscapes. Sustainability and environmental concerns are increasingly crucial economic factors. Global interconnectedness means future economies will be highly interdependent. Education and workforce skills will dictate a nation's competitive economic advantage. Government regulations and international agreements will influence economic trajectories. Housing costs represent a significant affordability challenge for many individuals and families. These costs encompass expenses related to renting or owning a residential property. High housing costs constrain household budgets, limiting funds available for other essential needs. Factors contributing to this challenge include limited housing supply and increasing demand. Economic conditions, such as wage stagnation, also exacerbate housing affordability issues. Addressing this challenge requires comprehensive strategies involving policy and market interventions. Healthcare costs represent a substantial financial burden for individuals and families. These costs encompass expenses such as insurance premiums and out-of-pocket payments. High healthcare costs can lead to delayed or foregone medical care. This can result in adverse health outcomes and increased long-term expenses. Addressing healthcare costs is crucial for improving financial stability and public health. Education costs are steadily increasing across various levels. This increase is primarily reflected in rising tuition fees at colleges and universities. Additional fees for services and resources also contribute to the overall cost. The trend of rising costs poses financial challenges for students and their families. Childcare costs represent a significant financial strain for many families. These expenses can encompass daycare centers, nannies, and after-school programs. The high cost of childcare can limit parents' ability to work or pursue career advancement. For low-income families, childcare expenses can consume a substantial portion of their income. Government subsidies and tax credits can help alleviate some of the financial burden. Affordable and accessible childcare is crucial for supporting working families and promoting economic stability. Asset appreciation refers to the increase in the value of an asset over time. This increase can occur due to various factors, including market demand and economic growth. Real estate, stocks, and commodities are common examples of assets that can appreciate. Appreciation benefits asset holders by increasing their overall wealth. However, the benefits of asset appreciation are not always evenly distributed across generations. Older generations who acquired assets earlier may experience greater gains compared to younger generations. Household budgets are increasingly strained due to rising costs of essential goods and services. Inflation erodes purchasing power, making it difficult for families to maintain their standard of living. Increased expenses in areas like housing, food, and transportation contribute significantly to budget pressures. Many households are forced to make difficult choices, cutting back on non-essential spending. Savings rates may decline as more income is allocated to cover immediate needs rather than future investments. Government policies and economic conditions play a crucial role in alleviating or exacerbating these financial challenges. Purchasing power refers to the quantity of goods or services that can be bought with a unit of currency. Inflation erodes purchasing power, meaning each unit of currency buys fewer goods, services. As prices rise due to inflation, the real value of money decreases. This decline in real value reduces consumers' ability to afford the same amount of goods and services. Economic security is a state where individuals and communities have stable access to resources. This access ensures basic needs are met, including food, shelter, healthcare, and education. Instability, such as job loss or economic downturns, directly threatens economic security. These threats can lead to increased poverty and reduced overall well-being. Addressing these threats requires proactive policies and support systems. Emergency relief refers to temporary measures implemented to alleviate crises. These measures provide immediate support during critical situations. During the COVID-19 pandemic, emergency relief efforts were intensified. These efforts aim to mitigate the pandemic's impact on individuals and economies. Job losses can significantly diminish household income. Reduced income directly impacts individuals and families' ability to afford essential goods and services. This erosion of purchasing power negates any previous gains in affordability. The loss of employment can lead to increased financial instability and economic hardship. Consequently, job losses counteract efforts to improve living standards and overall economic well-being. Economic shocks can leave lasting scars on individuals and economies. These scars manifest as reduced productivity and lower potential output. Labor market hysteresis, characterized by prolonged unemployment, is a key factor. Reduced investment and innovation further contribute to long-term economic damage. Global inflation refers to the increase in the general price level of goods and services across the world. It signifies a decrease in the purchasing power of money on a global scale. Several factors contribute to global inflation, including increased demand and supply chain disruptions. Rising energy prices and geopolitical events can also drive global inflationary pressures. Central banks worldwide monitor and respond to global inflation through monetary policy adjustments. Vulnerabilities can significantly exacerbate existing crises. These weaknesses, if exploited, amplify the negative effects of the crisis. The presence of vulnerabilities can hinder effective response and recovery efforts. Addressing vulnerabilities is crucial to mitigating the overall impact of a crisis. Unattended vulnerabilities can lead to prolonged instability and increased damage. Rising costs refer to the increase in the price of goods and services over a period. These increases can significantly impact daily life for individuals and families. Higher prices reduce purchasing power, meaning people can afford less with the same amount of money. Essential items like food, housing, and transportation become more expensive, straining household budgets. This can lead to difficult choices, such as cutting back on discretionary spending or delaying important purchases. Wage stagnation refers to a prolonged period of little or no growth in real wages. Real wages are wages adjusted for inflation, reflecting actual purchasing power. This means that even if nominal wages, actual dollar amounts, increase, the cost of living rises at a similar or faster rate. Consequently, individuals' ability to afford goods and services remains stagnant. Wage stagnation can lead to economic hardship and increased financial stress for workers. It also contributes to income inequality, as wealth accumulates at the top while wages remain suppressed. Ethical considerations in economics involve moral questions about economic activities. These questions concern fairness, justice, and the impact of economic policies on individuals and society. Ethical implications arise in areas such as income distribution, resource allocation, and market behavior. Addressing these ethical concerns is crucial for creating a more equitable and sustainable economic system. Economic success is fundamentally linked to the concept of affordability. Affordability ensures that goods and services are accessible to a broader segment of the population. Increased accessibility drives demand and stimulates economic activity. When more people can afford essential items, overall living standards improve. Affordable pricing can foster competition and innovation within markets. Therefore, affordability is a key determinant of widespread economic success and societal well-being. Philosophical considerations extend beyond mere statistical analysis. They delve into the underlying assumptions and interpretations of data. Ethics play a crucial role in how data is collected, analyzed, and used. Epistemology examines the nature of knowledge derived from data. Metaphysics explores the fundamental nature of reality as represented by data. These philosophical dimensions provide a deeper understanding of the implications of data-driven insights. The central debate is being reframed around the core issue of affordability. Affordability concerns the ability of individuals or households to meet their basic needs. This includes essential expenses such as housing, food, healthcare, and education. Focusing on affordability highlights the challenges faced by those with limited financial resources. It shifts the discussion towards ensuring equitable access to essential goods and services. Family well-being is significantly influenced by financial affordability. Affordability refers to the ability of a family to meet its essential needs and desired living standards. These needs include housing, food, healthcare, education, and other basic necessities. When essential needs are unaffordable, family well-being is negatively impacted. Financial strain can lead to stress, reduced access to healthcare, and limited educational opportunities. Therefore, affordability is a critical factor in ensuring the overall health and stability of families. Affordability significantly impacts individuals at different stages of life. Young adults face challenges in affording education and initial housing. Families with children often struggle with childcare and larger housing costs. Mid-career individuals may prioritize saving for retirement and managing mortgage payments. Seniors often deal with fixed incomes and rising healthcare expenses, affecting their affordability. Economic fragility refers to the ease with which financial gains can be reversed or lost. This implies a vulnerability to negative economic shocks or instability. Even improvements in affordability can be quickly eroded by unforeseen circumstances. Therefore, fragility highlights the precarious nature of certain economic advancements. The economy should prioritize the well-being and needs of people. Economic policies should aim to improve living standards for all. Ethical considerations should guide economic decision-making. A people-centered economy focuses on fairness and equity. The economy of the next generation will be shaped by technological advancements. Sustainability and environmental concerns will play a crucial role. Globalization and interconnectedness will continue to increase. Adaptability and lifelong learning will be essential skills for success. Economic narratives often present idealized visions of future prosperity. These narratives can influence policy decisions and public expectations. However, economic realities frequently diverge from the initial promises. Unforeseen factors, such as market fluctuations or policy failures, can alter outcomes. A critical analysis of economic narratives is essential to understand the gap between projected benefits and actual results. Economic progress is a complex and multifaceted concept. Its definition and measurement are subjects of ongoing debate. Different perspectives exist regarding what constitutes true progress. Traditional metrics like GDP are often questioned for their limitations. Alternative indicators aim to capture broader aspects of well-being and sustainability. Rising prices are a significant factor in economic crises. Increased costs of goods and services can destabilize markets. Inflation erodes purchasing power, affecting consumer spending. Businesses may struggle with higher production expenses. This can lead to reduced economic activity and potential recession. Household expenses are the costs associated with maintaining a home and supporting its occupants. These expenses can include housing, food, transportation, healthcare, and utilities. Increasing household expenses can place a significant strain on a family's budget. This strain may lead to difficult financial decisions and reduce savings. Economic policies significantly influence the affordability of goods and services for consumers. Fiscal policies, such as taxation and government spending, directly affect disposable income. Monetary policies, like interest rate adjustments, impact borrowing costs for individuals and businesses. Trade policies, including tariffs and trade agreements, can alter the prices of imported goods. Regulatory policies, such as price controls, can set maximum prices for essential goods and services. Therefore, understanding economic policies is crucial for assessing and addressing affordability challenges. Many individuals are facing an increasing financial burden. This burden is due to a combination of factors. These factors include rising costs of living and stagnant wages. The result is increased financial strain on households. The COVID-19 pandemic triggered significant economic disruption worldwide. Lockdowns and social distancing measures severely impacted numerous industries. Supply chains were disrupted, leading to shortages and increased costs. Unemployment rates surged as businesses were forced to close or reduce operations. Consumer spending declined sharply due to uncertainty and economic hardship. Government interventions, such as stimulus packages, aim to mitigate the economic fallout. Inflation erodes the purchasing power of money. This means that with inflation, each unit of currency buys fewer goods and services. As prices rise, the real value of money decreases. Consumers can afford less with the same amount of money. Therefore, inflation directly reduces the quantity of goods or services that can be acquired. Economic security can be compromised by unforeseen shocks. These shocks can disrupt financial stability. Such disruptions can lead to widespread economic instability. This erosion affects individuals and entire economies. Household income is influenced by a multitude of factors. These factors can be broadly categorized into economic conditions. Individual characteristics also play a significant role. Government policies and interventions can impact income levels. Education and skill levels are key determinants of earning potential. Employment opportunities and industry trends further shape household income. Economic stability is a state where an economy experiences sustained growth with minimal fluctuations. It ensures predictable financial conditions for individuals, businesses, and governments. Maintaining economic stability requires careful management of inflation, employment, and debt. Generational concerns arise from the long-term impact of economic policies on future generations. Sustainable economic practices are essential to secure prosperity and stability for successive generations. Economic shocks are unexpected events that significantly disrupt an economy. These shocks can originate from various sources, including natural disasters. They can also stem from financial crises or sudden policy changes. Economic shocks often expose underlying vulnerabilities within a system. These vulnerabilities may include high debt levels or dependence on specific industries. Understanding these vulnerabilities is crucial for mitigating the impact of future shocks. Economic activities and policies raise significant ethical questions. These questions concern fairness, justice, and the distribution of wealth. Ethical considerations also involve the impact on different social groups. Moral implications arise from decisions about resource allocation. Economic systems are often evaluated based on their ethical foundations. Debates occur regarding the moral responsibilities of economic actors. Economic success can be evaluated based on the affordability of goods and services. Affordability reflects the ability of individuals to purchase essential items. Lower costs relative to income indicate greater economic success for individuals. Widespread affordability suggests a healthy and successful economy overall. Therefore, affordability serves as a key metric in assessing economic well-being. The economic future involves strategic planning for the prosperity of subsequent generations. It necessitates considering the long-term impacts of current economic policies and practices. Sustainable development is a key component, ensuring resources are available for future use. Investment in education and innovation is crucial for fostering a competitive workforce. Addressing income inequality promotes social stability and broad-based economic growth. Effective governance and regulatory frameworks are essential for a stable economic environment. Generational divides often stem from differing economic experiences during formative years. Each generation encounters unique economic conditions, such as recessions or booms. These conditions shape their financial perspectives and behaviors. Access to education, job markets, and housing affordability vary significantly across generations. These disparities contribute to differing economic outcomes and opportunities. An affordability crisis is a complex economic challenge. It arises when essential goods and services become excessively expensive relative to income. This can impact housing, healthcare, education, and food. It leads to financial strain for individuals and families. It can also exacerbate social and economic inequalities.